Well, hello and welcome to another episode of the Lending Podcast. We are your hosts. I'm John Burnham. This is Jeff Jones.
Hello.
And we are coming to you from our newly renovated office where no pictures are hung up yet in the conference room.
It's beautiful back there. It's totally empty.
It's a great white wall. And yeah, we just changed some things around in our office. So we have pictures sitting around us here that still need to get hung up. But anyway, let's dive into all things mortgage.
All things mortgage. Well,
Yeah.
this is the Lending Podcast. Our goal is to provide you good information so you can make good decisions. And man, there is a lot of buzz about what the federal government is doing with the 50 bips rate cut yesterday.
Yes. September 18th, 2024, the first rate cut in over 4 years. We got 50 basis points. And what is basis points? That's like half a point. So 1% is 100 basis points. So we got half of a percent, which equals 50 basis points. And what did they actually cut? Did they cut mortgage rates a half a point, or did they cut something else a half a point?
Don't we all wish it was mortgage rates
Yes,
they
we
cut?
do.
They did not cut mortgage rates a half point. That is a misnomer. So the federal funds rate is really what is driving that change that he's putting in there. So basically, when you look at like auto loans or credit cards or other bank debts, it's those kinds of things that are built off prime rate.
That's right.
What we don't operate off that in our mortgage industry. So it is sometimes a rate cut actually increases mortgage rates. Sometimes a rate cut also decreases mortgage
That's
rates.
right.
It depends on the environment and why it's happening. The why is critical.
Yeah, and there was a lot of speculation build up
Mm-hmm.
leading into this Fed meeting. We really had a good feeling from the end of July, beginning of August, that the Fed would cut in September, and then Jerome Powell came out and said we're gonna change direction, we're gonna change courses here, and we are gonna cut. We were anticipating 25 basis points of a rate cut. At least I was. 86% of the analysis was on a 25 basis point rate cut. About 14% believed it would be a 50 basis point rate cut. So they kind of surprised us a little bit, with a pleasant surprise, with the 50 basis point rate cut. And so what exactly did that cut? Well, that cut the Fed funds rate, as you said, Jeff. So it cuts the rate that banks loan other banks money. It cuts the Fed funds rate, which is directly related to prime as well. So the prime rate was 8.5% before this cut. Now it's 8%. The Fed funds rate is right around 5 or a little under.
Right.
And so banks are borrowing money at basically 5%, so they can lend it out at about 8% at prime rate on consumer debt. And we're also talking about construction loans, maybe. So it could be a land loan, a construction loan, a unsecured installment debt at a bank, auto loans, of course. And there's auto loans at 4, 5, 6% out there somewhere too. Those are promotional loans, if you will, by certain institutions that want to give their higher credit borrowers and their loyal customers a better product, better rate product, right? So there's always a kind of a promotional loan out there for certain products, for certain banks, credit unions, et cetera. That's not mortgages, though.
Right.
We're a totally different animal.
Yeah. So if you're one of our usual listeners and subscribers, thank you for subscribing. But this episode's really not going to be about what an interest rate is built off of. That is episode 17. I would love for you to go back and listen to episode 17, Your Interest Rates Explained. This one is really kind of what we're seeing in the messaging out there. So there's a lot of confusion. So, okay, Fed's cut rate, what does this mean for me as somebody that wants to buy a home? And so that's what we're going to be focusing on. There's a lot of, I'm seeing everything on social media.
Yes.
Right? And there's a lot of good, bad, and otherwise on there.
Yes.
That is a lot of misinformation. It's one of our goals of us spending time in front of our camera to get information to you is because we want to counter the misinformation that's out there. I mean, there are times when you're going to see people posting interest rates that aren't licensed lenders. Now, we just came out every year. It is required for us to have an NMLS, for us to be licensed lenders, mortgage loan originators,
right,
to have an 8-hour continuing education course. One of the hot button topics this year was people quoting rates online that are not lenders. Now, if you're not a licensed mortgage loan officer, you're not allowed to quote rates at all, no matter who you are. If you don't have an NMLS number, you can't quote rates like that, or if you're not a bank. So why are they doing it?
Well, because it's so easy to share content,
Yes, it's
right?
so
You
easy to
see
share.
something that really is compelling, and then you want to share that. And there's nothing wrong with sharing a post that's been posted under the proper compliance, right? If the post has all the requirements met of compliance in our industry, it's very heavily
Right.
regulated, and you see something, they have the interest rate, they have the APR, they have all the different disclaimers, the fair housing, equal housing opportunity, I should say.
Hmm.
They have all that documentation or all those things on the post. Then sharing that's probably no problem. What you need to be aware of out there, if you're not a licensed originator, is when you're sharing content that may or may not be compliant from the source, and then you've posted something that wasn't compliant. Now you've got it on your socials that's not compliant. And the CFPB, the Consumer Finance Protection Bureau, is looking for that stuff, right? And
Yeah,
they're going to
they're
crack
the
down on
the
that.
CFPB. They sound like a police department. They kind of are.
Right.
So that's what they do. They give fines. They can take licenses away. All that good stuff that we don't want to be on the radar. No one wants to be on the radar. You might get on the radar and then find out you're fine. But I like what you said. I think that if you are wanting to, if you see somebody that has a legitimate quote going on the website, like advertising a market rate, and it has the asterisks, it has the APR, it has all their financial information with their NMLS number, you can reshare that post with their content on it, with their name on it and all that good stuff. You just can't post it as yourself.
Right. And
Right.
creating the content to post about interest rates when you're not licensed
Right.
is really kind of dangerous for you.
And
Yeah.
so let's talk about why. So what that does is if for some reason somebody accidentally does it, whether it's somebody else in the real estate industry that just wants to inspire people, hey, rates have gone down to this level.
Could be a home builder,
You know,
could
the
be a realtor. Yeah.
yeah, the goal was a positive like intention
Mm-hmm.
to inspire people that affordability is getting better, which it is. So
Yes.
affordability is getting better. If you're out there, this is September of 2024. And so we want to celebrate that in our real estate community because a lot of people are waiting. And so you're encouraging them, you don't need to wait. Rates are back down into this area that can make it more affordable for you. That's great. But the reason why we can't use numbers if you're not a licensed lender is because you're actually providing misinformation if you're quoting a rate without assessing risk.
Right. Right. Yeah, and I think let's touch on the fact that rates have gotten better. So I was thinking
Yeah.
about this on Wednesday as the Fed came out with their decision. And make no mistake, we are super excited about the rate cut. That's a big deal. We've
Yeah.
been anticipating this cut for a while. It means that inflation has really cooled. It means that there are some aspects of economic data that have cooled slightly. The Fed is trying to give us this soft landing, as they say, which a perfect balance of unemployment and job growth and economic data without that 7, 8, 9% inflationary market that we had for a while there in 2022 and a little bit in 23. So inflation has come back down. That's a smiley face. Interest rates have now started to come back down. The cool thing I think about the Fed rate cut is that the Fed rate cut is bringing to light what we've already known over the last month, which is mortgage rates have come down about 1% in the last month. I mean, just in about six
Yeah.
weeks from the beginning of August
Right.
to middle of September, we've seen such a huge rate drop. Now, if you're not really following the mortgage rate market, if you're not really in the market to buy a home, you're not in the market to refinance, then you wouldn't necessarily have seen those subtle changes, sort of that gradual decline over the last 6 or 8 weeks. Then the Fed makes a decision, it brings it to light, it puts it all over the socials, which I think is really great because it does bring that positivity in those posts. And we're talking about more of the compliance, regulation side. We kind of have to because that's our industry.
Right.
We need to be compliant. We need to be putting good information out there. At the end of the day, though, the Fed rate cut is bringing that headline that's getting people excited. And then when you realize, okay, rates have dropped, ironically, mortgage rates have dropped, but it's not because of the Fed. But then folks are finding out that, oh, rates are actually better than I thought they were because of that Fed headline. So in a roundabout way, it's brought light to that subject. So that's exciting. That is really positive, and we're now seeing rates that we haven't seen in almost 2 years.
Yeah, and I think that's good to know that we've had betterment, of rates for 12 months.
Yes.
So what's happened is with the peak high in November of last year, 2023, where rates were over 8%, on a national average. Now that's like the par rate of a national average across America, but at 8%. And then we dropped down January to mid sixes, then up to 7.5 again this year, right? But since really April of
Yes.
this year, we've been coming back down. And so now we are more than a point lower than what we were at in April.
Yes.
So we are more than 1% better than just April. So we've had all this movement and all this eventual betterment with no Fed rate cut.
That's right. That's
already.
right.
So it's
because
yeah.
it was priced in to some degree, and you might hear that out there
Right.
if you're reading some of the posts that mortgage rates didn't really change. In fact, they ticked up just a hair on
Yeah, we went up
Wednesday.
yesterday.
They went up, and we do everything in basis points, right? So
Right.
that's a basis point is 0.01%, right?
Yeah.
It's 1 out of 100, 1 basis point. So if mortgage rates move 4 basis points, you're talking 6.11 to 6.15. That's not moving the needle on your payment much.
Right.
I mean, yeah, if you have $1 million loan, you probably feel that a little bit. If you have a $200,000 loan, you're probably not feeling it. It's maybe $5 a month, but it's not a lot of money. So when those rates move, and we talked about this before, it's not really the interest rate that moves. We talk about it's the cost to obtain that rate that moves. What drives those averages is they are quotes. They're quoted rates. They're not the average rate that someone's actually closing on. It's the average that's being quoted. Now, here's the fine print, and this is why it's a little dangerous to post rates out there if you're not licensed, because the average rates come with average costs. More costs, less costs. More costs, you're going to see a lower rate. Less costs, you're going to see a higher rate.
Right.
And so the averages put everything in a pot, mix it up, stir it up. 6.15. And so that's what you kind of see. So when rates move up and down, it's really the quoted rates that are moving up and down because the costs to obtain those rates have changed. And that's confusing to a lot of folks.
So what are we saying? What we're saying is really, when we get in trouble when people go, what are rates today? We get that asked all the time, right? What are rates today? Where do you think they're going to be tomorrow? And so this whole industry with your license, we pretty much are scared to quote rates because we don't want to make promises we can't deliver on if a borrower comes with a lower credit score than a rate that we're quoting basically matches up to.
Yeah.
So we match risk to cost, right? And so that's what you're talking about. So if somebody asks what rates are today, well, I don't know what your rate is going to be without a full application.
That's right.
Right. And so
and be leery of someone who will quote your rate without all the information.
Yes.
And that's kind of what you're saying. Like,
right.
We're not going to get over extended and quote something before we have all the information. It's like a doctor prescribing the medicine before they've actually done the full exam.
Right.
Or prescribing a treatment for you.
Yeah. And we can pretty much kind of tongue in cheek say rates are anywhere from 3.75 to 8.75. And what I mean by, I'm not being like rude, that's the rate sheet I see. So that hasn't changed.
That hadn't changed.
Pretty much my career.
Right.
So, well, no, that's not true because we were down to 1.1, the ones before.
True.
So those have ticked up. But basically, what I mean by that is we all have the same rate sheets that rates aren't changing, right? It's the cost that changes.
Every consumer has access to the same rates, yes, but the cost to obtain those rates is different.
And so what people are really asking is what rate doesn't cost anything today?
Yeah.
So, and they might not know that's the question they're asking, right? And that's a hard question for us because we don't know what it's going to cost that person compared to that person because there is variation of risk between people.
And so we factor in credit score, we factor in property type, we factor in all these different, how much down, all that loan to value. And I think in one of the episodes you said there's 64 different factors or 65 different factors to actually get a rate quoted. And that's true because there's all these different criteria that we want to go through. So circling back to the bottom line here, with the Fed lowering the short-term rate, the overnight lending rate, it's the first step of what we foresee will be many more uh, drops. And so that's huge. So now that we've had the first one, that's under our belt, there's more drops perceived coming in the future. So the bond market, the mortgage market, is going to factor in those future rate Fed drops and price the loans accordingly. So we could even start seeing mortgage rates come down before the next Fed meeting. They may not. They may stabilize if the dialogue and the perception is the Fed's going to keep them the same.
Right.
Maybe they don't lower the next Fed meeting. So we might not see mortgage rates move very much.
Mm-hmm.
But just, overall, be cautious of the posts that that are giving you a rate without all the disclaimer. That's the bottom line.
Yeah, it's basically, and again, people might have good intentions, but it's just clickbait, right?
Yes.
Which we all have clickbait to a point. We want to make sure we get people's attention or it starts a conversation, but there's a reason why you can get fined for doing it.
Yes. Yeah, that's true.
Because there is ways it can cause harm. And we don't want to be a part of that. We want to encourage people, don't do anything that can cause harm. If you really want to post, get a hold of a letter that could put a post together that you can share. That's a wonderful way to do it correctly.
Mm-hmm.
So please do that. If you want something from us, we'd be happy to look at that for you. So communicate with us if you're in Texas. And we're here for you. We would love to get a great post together for you. Yeah. So I don't want to discourage people to not celebrate what the market's been doing because it's been getting really healthy. But I also don't want people doing things that they shouldn't be doing.
Yeah.
Legally.
Yeah. Yeah. And so where does that take us the next few months? I mean, we're coming up to the end of the year, and I'm having a lot of conversations about, hey, I want to buy in the spring or I want to buy next summer. And we talk about this a lot. It's never too early to have that conversation. I just this morning had an agent that called me and he said, hey, remember these past clients? They want to talk to you in a couple weeks. Just put a mark on your calendar in a couple weeks to reach out if you haven't heard from them. And so there are folks right now that are planning. We all have a calendar in our head. We have family events coming up. We have work commitments. We have social commitments. And so we're planning the next steps. And interest rates, let's be honest, is a big part of the discussion. It has been for the last 5 years, really. We had a very stable market up until COVID, and then it got a little bonkers. And of course, we've had a higher rate environment for the last 2 years. So looking through the crystal ball here, we do believe, I'm not going to say we, I'm going to say me, because I can't speak for you, but I believe that there are future Fed rate cuts coming in the next 3 to 6 months. I believe interest rates will continue to go down gradually. So should you wait?
That's a good question.
Buy something?
Great question. I would say it depends. I'd say 9 times out of 10, it's probably good for you not to wait. And now might be your best time to buy. If you want to buy in the next 12 months, now might be better than 12 months away because there's so many benefits to owning early. You know what I mean? So you're going to be building equity. You're going to be getting tax breaks. You're going to be getting all kinds of stuff you might not be getting. I won't know until I see somebody's scenario. So I don't like giving advice like that other than 9 times out of 10 it's a yes, it's a good time to buy.
Right. Yeah, just yesterday having a conversation with a financial advisor, we were exploring that objection that she gets as a financial advisor sometimes from her clients, that they're building their savings for a down payment. I'm waiting to buy a house because I'm trying to get to that 20% down or 10% down. And most of our clients do not put 20% down. I mean, some of them do, yes. If you're selling a house, you're buying a house, you might have a big chunk you're putting down, but it's not really the time to try to save and wait to get to 20% down, because you have more inventory out there as a buyer right now. You have more options, and now you have some lower interest rates. Again, not just because of the Fed, but because what the mortgage markets have done the last really 5 months, like you said, since April, it's been a gradual decline. I mean, really, really nice improvement in mortgage rates. And in some cases, rates are maybe 2% lower on certain programs than they were 5 months ago. 2% on a $400,000 house or $400,000 mortgage, That's $8,000 a year in interest. Divide that by 12. That is almost $700 a month on your payment. So you can afford it. Like you really can. There's tools out there for the temporary buy downs. There's tools for permanent buy downs. So we get excited when we know that we've got clients coming in that were on the fence. I don't think that now's the right time. And then they've sort of made that decision. You know what? I'm seeing houses out there that I really like because there's a lot more options, a lot more inventory, and there's way more options. And we're helping folks make that decision. And like you said, it does matter. Like you may need to sell before you buy. You may need to get something fixed on your credit. You may need to save a little bit of money because you maybe don't have the
Yeah.
minimum that you need down. But you can get gift funds from a family member for down payment. You can take a loan out of your 401k if it makes sense. So there's just so many different ways to make these loans happen. And with rates that we're seeing, I think it's a really good time.
Yeah. No, I think that's true. Just to play, little devil's advocate, what will it take for rates to go up right now?
Ooh.
Because
Well,
there's a lot of people like we hear
yeah,
that say things very similar to what we've been talking about. It's like
yeah.
it might even continue to get better. But what scenarios make it possibly go up? Since people heard us say even
Mm-hmm.
yesterday rates went up a little bit. And they're like, well, why would that ever
Yeah,
happen?
yeah,
So what makes rates go up?
yeah. So what makes rates go up over the long term is an inflationary market with really, really strong economic data, like crazy strong economic data. Unemployment going down, job numbers going through the roof,
So spending going up, right?
spending going up.
CPI index
Yes,
doing the stuff we don't want to see.
those types of reports,
Right.
as encouraging as they are and as positive as they are for Mr. and Mrs. Consumer, they're not positive for the bond market necessarily because it could look like an inflationary market. The bond market, which controls mortgage rates, would not be as appetizing of an investment for bondholders. So we need more investors buying bonds to make rates go down.
Mm-hmm.
If less investors are buying bonds or more investors are selling bonds, essentially, it's going to make our yields go up, which makes rates go up, or the cost of the loans going up, right? So what would be some of those factors? Well, we're watching unemployment. We're watching the inflation numbers, the CPI, the PCE. We're watching the ADP payrolls number. How
Mm-hmm.
many new jobs have been created? It
Yeah.
was just like a month ago, where we had that revision in the jobs report where we had 818,000 jobs revised down from previous reporting. So we actually created 818,000 fewer jobs than the reports had shown. That was an indicator that actually helped the mortgage markets because it showed that the economy wasn't as strong data driven wise as we thought.
Right.
And so that weaker economy helps the bond market. And we're not rooting for a weaker economy,
Right.
by any means. It's just
We
that's
want you to get jobs.
of course, want a strong labor
Yeah.
market, but there's also that balance of none of us really want 8% mortgage rates. And we probably all will all agree that 3% mortgage rates were probably too low, right?
Not
So where's the
sustainable.
balance? Like,
Mm-hmm.
5 to 6% mortgage rate for a 30-year mortgage is a pretty darn good rate. And we're kind of in that range right now. So as crazy as it was when rates went to 8, and as crazy as it was when rates were 2, we've really met in the middle now, and we're creating quite a bit of equilibrium, I feel like, in our market for more inventory, fair interest rates on mortgages, good housing market, and great opportunity. And I read these articles about our first time buyers that are discouraged, and the Gen Z, or any other category where our buyers don't feel like they can afford a home, and the dream of home ownership for many is now fading, and that saddens me. Like I really like. I mean, 'cause obviously this is what we do for a living.
Yeah.
It's not about closing a transaction. It's about helping a family get into a home.
Right.
That's how we look at it. That's how I've always looked at it. And so it's emotional for our buyers in many cases, especially when there's some doubt that they can qualify. So we always say this, like, have the conversation. Don't disqualify yourself, right? Do not disqualify yourself. and know that there's a lot of options. And with rates coming down, that affordability is becoming better. And this might be the balance in interest rates that we have for the foreseeable future. We might not see rates that are much lower over the course of the next year. Personally disagree. I think they're going to continue to go down a little bit over the next year, but I could be wrong. And even though rates are going to go down, we're not saying you should wait, because you can always refinance, get the home of your dreams, and then refinance. Because if you wait, competition increases, the prices will rise because there'll be more buyers coming into the market. And believe me, we've seen this. Like we lived it.
Yeah.
When rates are really low. And so if you already own your home and rates are really low, you're refinancing. It's a good thing.
It opens a lot of doors,
Yeah.
right? So there's a lot of financial freedom that can happen when you own your home, what you can use your home for, what refinancing can do. Episode 34
Yes.
about refinancing and debt consolidation is a wonderful episode if you're interested in looking at what debt consolidation looks like now that you do own your home, and the betterment of a rate situation. And sometimes you want a good scenario. So the spend the least to save the most is always our slogan in that one. And if that's not going to work, then it might still be a waiting period for you. But in the end, you want a good lender to work on your scenario for you. But I think this was good. I think with the things we're hearing in the news and the media going crazy and social media going crazy about the federal rate cut of 50 bips, it's not 50%, it's a 0.5%. So let's not go crazy.
Right.
I was listening to Bloomberg, which is a fun commentary on these markets, and one person they had on there was saying we were 125 bips away, and they're only doing 50. They should have done 100. There's a lot of opinions out there that are messy, and what I like about the 50 was it wasn't messy. It was prepared for. I felt like, and this is one of the few times where I felt like this was a really perfect move on that timing. And I hope they cut more, because 4 years without a cut is ridiculous.
Yeah.
So let's get back to what they call neutral and finding that right balance of what makes sense for our economy and for the people out there.
Yeah, and if you have an adjustable rate type of loan out there, if you have a commercial loan, if you're a small business owner and you have a commercial
Right.
loan, as I do, have a commercial loan for a commercial property. If you have a home equity line of credit out there, that directly correlates with the Fed rate cut.
Right.
So if you have an SBA loan on a variable rate, the Fed cuts 50 basis points, your interest rate just went down a 0.5 point on the current loan you have. If you have a home equity loan that's tied to a variable rate, that rate just went down 50 basis points, and you may see it on your next mortgage statement next month.
Right.
So there is some direct impact to some of our consumers out there, which is huge.
Right.
It just doesn't correlate, as we said, directly to the mortgage market, but it's already been priced in. And if you really dive into what's the average rate today and what was the average rate in April 5 months ago, it'll really surprise you. We're down about 1.5 points on average from 5 months ago. That's a huge improvement.
Yeah.
Over 5 months. So will it move that much again over the next 5 months? I'm not sure. I think it will continue to go down a little bit. That's my personal opinion. Hope I'm right. But I'm probably not putting my own wager money on it, because we don't know.
Oh, we should do some side bets.
We'll
get in trouble if we start posting that.
Right.
All right. Well, this is another episode of the Lending Podcast. We are here to help you make good sense of all what's going on in the world with lending and mortgages. So thank you so much. Please like, subscribe, and share. And keep us tuned. If you want to hear something from us you're not, please put in comments like you'd love to hear it. We got another episode coming up that is also I think we get into more of the technicalities of this. So if you liked what you heard and want to know more about how the mortgage-backed securities work, we're going to get into it.
Yes, we are.
All right.
Thanks for being with us today.